When you need temporary cash flow support to bridge the gap between paychecks, turning to platforms like Possible Finance can feel like a straightforward solution. However, thousands of applicants run into unexpected rejections, bank fees, or deeper financial stress simply because they fall into common application traps. Understanding how automated underwriting algorithms evaluate your application and how to align your borrowing with your true financial capacity is the difference between an effortless approval and an expensive mistake. One of the most frequent errors applicants make occurs during the initial account linking process. Possible Finance relies heavily on reading your bank account history through secure data connections rather than relying solely on traditional hard credit pulls. A common pitfall is linking a secondary bank account, a prepaid debit card account, or a freshly opened checking account that lacks a steady history of direct deposits. When the system evaluates an account without at least 2 to 3 months of consistent payroll deposits, it cannot verify income stability, leading to an immediate decline. Always link the primary account where your regular employer payroll or main income arrives. Another major issue is submitting an application while your checking account balance is sitting in the negative or repeatedly hitting zero. Many people wait until their account is completely drained or already hit with non-sufficient funds fees before applying. Algorithms look at your daily ending balance and transaction history over the past 30 to 90 days. If the system sees frequent overdraft fees, bounced debits, or a recurring $0 balance right before payday, it flags the applicant as high risk for default. Maintaining even a modest cash buffer and avoiding overdraft triggers in the weeks leading up to your application substantially strengthens your profile. Simultaneous borrowing, often called loan stacking, is another critical mistake. If your bank statement shows active recurring debits from multiple other cash advance apps, payday lenders, or microloan services, underwriting systems flag this as credit hunger and financial distress. Even if your income supports the payments, carrying multiple concurrent short-term obligations drastically increases your debt-to-income risk. Clearing or minimizing existing short-term advances before applying presents a significantly cleaner picture to the lender. Misunderstanding repayment schedules is where long-term financial strain begins. Possible Finance structures repayments into 4 biweekly installments, designed to align with typical paydays. A frequent mistake is selecting installment dates without accounting for automatic bills, rent, or other fixed expenses that land on the exact same days. If an installment debits on the same morning your rent payment processes, you risk triggering bank overdraft fees. Before finalizing your schedule, cross-reference every installment date with your full monthly budget to ensure your account will comfortably handle the deduction. Borrowers also frequently overlook the credit reporting impact. Unlike traditional payday loans that operate off the grid, Possible Finance reports payment history to major credit bureaus. On one hand, paying every installment on time serves as an actionable step to build positive credit history. On the other hand, late or missed payments will directly harm your credit score. Treating this as a casual short-term advance rather than a formal credit line can damage your financial standing for years. Finally, the ultimate mistake is relying on short-term installment loans as a permanent supplement to regular income. Borrowing to cover recurring basic needs creates a continuous cycle where each new paycheck is immediately depleted by previous loan repayments. To use these tools effectively, treat short-term financing strictly as a temporary bridge for unexpected, one-time emergencies while simultaneously building a dedicated cash buffer to prevent needing short-term debt in the future.